Hello and welcome to the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya,
And my name is Tamanna Surya.
and today we are thrilled to have Kris Kania as a guest on this podcast to discuss the crisis in private credit, business development companies, and specifically Blue Owl. I got a chance to meet Kris at a Capital Alliance event in San Diego last month. It was fascinating to discuss private credit and PE firms with Kris.
Absolutely. Kris, thank you so much for coming on. We really appreciate it and are looking forward to our conversation today. So, not only are you the founder and portfolio manager of KSK Capital, you're also a professor at NYU Law. To kick off our episode for today, we'd love to have you tell us a little bit more about yourself, maybe even diving into these two fascinating professions.
Yeah, absolutely. And first, let me just say thank you for having me. I've been a longtime listener of the podcast and also, really enjoyed your book, Asif. And it's just a pleasure to continue the conversation we had on that yacht with you. And very nice to meet you as well, Tamina. Um, so in terms of my background, it is a bit of a non-traditional background in that I started on the buy side actually after college, investing in software companies at Susquehanna International Group, an affiliate of Susquehanna called Susquehanna Growth Equity. There, I was very fortunate to get a sense of how to do a value-oriented approach in an otherwise very growthy asset class. I also got exposed to the Howard Marks memos and learned a little bit about the psychology of markets, which I find to be fascinating and particularly acute in public markets, less so in private markets. But while I was there, one thing that my mentor said, probably jokingly, was it would be nice to have a law degree in an XYZ situation, but I think I took that advice really to heart, and that brought me eventually to law school at NYU. And I know this is a longer story than maybe you were asking for, but just to paint the full picture, at NYU, I was just learning as much as I could about corporate law, litigation, kind of the whole menu of options, but really found my footing in tax law. Um, so that eventually brought me to tax practice at two prominent law firms, first Kirkland and Ellis in New York, and then Sullivan and Cromwell. At both of these firms, I still had the investing bug, deep in the back of my mind, but my day-to-day was, late nights, drafting documents and advising clients. And there I really got exposed to some fascinating special situations. At Kirkland, in January 2023 or so, I was had Carvana as a client, and we were advising them on some pretty interesting liability management transactions, and the beginning of what ended up being a pretty successful turnaround. Um, Later, in my time in big law, I was also working with Neiman Marcus on their sale to Saks Fifth Avenue, and that was also a fascinating transaction, a fairly difficult one, but one where at least I learned a lot about, what M&A looks like in a more stressed context. And I guess a third situation that I really remember fondly and would say was a formative experience for me was working with the special committee of Massimo when they were approached by activist Quentin Coffey and Peloton Capital to divest of their sound business. And that too was just fascinating to be at least a fly on the wall in the room. Um, but eventually I wanted to bring my legal background to investing, and particularly in the auction-driven public markets, where psychology, I think, is just as important as fundamentals. And I wanted to infuse my investing approach with a variant perspective that is mainly based on legal, regulatory, and policy analysis. And it was with that thesis that I had launched KSK Capital, and I was fortunate to launch with the support of partners at some of the law firms I mentioned. Um, at the same time, and to answer your question more directly, I also found myself in the amazing seat of being a visiting assistant professor of tax law at NYU. I've been teaching now for about a semester and a half, and very much the most ignorant person in the room at faculty meetings when it comes to discussing, big, heady questions of law and justice. But I very much feel like a student because I'm the faculty, the students, the staff, all of them are working on really interesting projects, not just in tax law, but antitrust, shareholder activism, corporate governance. And I'm trying to soak as much of that in as they'll let me, and give back as well by teaching tax law in a way that exposes students to some of the funkier, more complex situations in the market. So yeah, that's kind of where I am today. I'm both a professor and an investor, and I'm trying to, make my teaching better through market knowledge and vice versa.
That's wonderful, Chris. I think you might be one of the only people I know who might talk about distress situations like Carvana or Neiman Marcus being sold to Saks as a time you remember fondly. Um, Carvana went, if I remember correctly, from over $300 a share all the way down to less than $5, maybe even $3. It lost 99% of its value. And investors have made money both on the long side and the short side, as well as lost significant amounts of money on the short side. We followed all the insider sales of mostly the elder Garcia, the father Garcia, all the way up to 300. And then they started buying again around the time of that Apollo transaction, right before that, actually. And then they started selling very significantly yet again as it rose up to maybe over $400 this time around. Fascinating situation all around. Massimo was interesting. We were talking about that on the podcast not too long ago. It was a company I came across 13 years ago because Joe Kania was buying stock on the open market. And I remember following it. They had the pulse oximeters, and they managed to get sales of Apple Watch to stop for some period of time because of that lawsuit.
That's right. And the IP litigation against Apple would be probably part of the special situation toolkit of an investor looking at that stock. And I think it's an example where the public markets have a tendency to maybe underappreciate, legal related assets. I think there's just a tendency to call it a zero until you come to judgment day. So, of course, I was a lawyer at the time and not an investor, but I would imagine someone with a strong IP law background being able to capitalize on that.
Absolutely. Speaking of that special situations investor toolkit as well as insider activity, I think our conversation today is largely going to center around BDCs, which is quite timely because we're seeing significant insider activity in business development companies or BDCs across the board. And not a day goes by where we don't see some insider buying shares. For those of us who don't normally focus on this segment of the market, could you tell us a little bit more about BDCs? And then it would also be great if you could give us a picture of the private credit market at large.
Yeah, absolutely. Now, I'm going to try to condense my answer into 5 minutes because I do have a tendency to babble, and it's actually a pretty interesting but long story. I would say, to answer the question directly, BDCs, you could think of, they're business development companies. You can think of them as a credit fund. They're a corporation. It's a wrapper around a pool of loans. And from a tax perspective, it's an attractive way to invest for tax exempts, individuals, foreign investors. The BDC legal structure is able to attract all of those different kinds of investors into a loan-oriented vehicle in a way that a private fund or partnership might create certain problems. The BDC was created, at least in part, to promote the financing of middle market companies that might not have all the resources to access the bond markets, for example. So it's meant to promote generally capital formation at that middle market scale. And the BDC has also become an important product for the large publicly traded asset managers, whether we're talking about Blue Owl or Blackstone. And I would also consider the BDC to be like a legal cousin of the REIT, which is of course an instrument to both invest in pools of real estate equity or even real estate mortgages. And just like REITs, BDCs can be both private or public. And these asset managers have publicly traded BDCs, like OBDC is the Blue Owl BDC, and Blackstone has their product as well. And those two are generally like the largest in the market right now in the public markets, but they also have private BDCs as well. But now the kind of fuller context of private credit and how we got to where we are, I would say there's three important kind of themes that I think brought us to the present moment. The first is that companies in the United States are able to stay private for longer. The statistic that comes to mind is something like 85 or 86% of US companies with revenues of $100 million or more are private businesses. And that is for a variety of reasons that we don't necessarily have to get into, but I would say it boils down to the increasing costs and compliance of being a public company, as well as the availability of capital in the modern markets as a private company that allows you to stay private for longer. The second, I would say, macro theme or mega trend that has led to private credit and where we are today is the work of, frankly, like Michael Milken and Drexel back in the 80s. And honestly, I think all roads in the world of alternatives point back to that team. But I guess the narrow point I would like to make is that him and his team had the intuition that there's a price for everything. And when you have a fallen angel, a former institutional grade borrower, you could still make a profitable investment as a lender when you buy it and it's in the territory of distressed. And in addition, if that's true, then even originating credit from startups or riskier businesses could also be profitable. So his team and their progeny, who sit at firms like Apollo and others today, kind of paved the way for credit to not just be institutional grade, but also non-institutional grade. So I would say that's the second big theme, that non-institutional grade credit is very much an established asset class, both in the public markets with high yield bonds, as well as in the private markets. You could say with leveraged loans, for example. And that now brings the third mega theme, and this is something that really began, I would say, post financial crisis and the government's regulatory response to the financial crisis, which is, traditionally the leveraged loan market, i.e. the private loans being extended to riskier borrowers, more leveraged borrowers, often companies run by private equity, would be the business of banks, traditional banks, JP Morgan, Bank of America, etc. Post GFC, these banks started to move a bit away from storing, leveraged loans on their own balance sheets and really shipping it out more and offloading that risk to investors. And ultimately, lenders are going to be one of two categories. They might be a bank or they might be an investor. And banks were under a lot of pressure to no longer really be in the balance sheet game when it comes to lending to high-risk companies. They could still originate the credits, but most of the time they're syndicating it out and shipping it out to a pool of investors. With that kind of dynamic at play, the banks have sort of assumed a position of an intermediary between the borrower and the ultimate owner of the credit. And that creates a bit of friction in that the person who's really bearing the economic risk of the loan is not the closest person to the underwriting or the closest person to the company. Private credit players saw that kind of inefficiency, so to speak, and said, why not, bring the underwriting closer to the borrower? And as John Gray and Blackstone puts it, go farm to table. The bank is just kind of interfering with our due diligence. So that concept of banks going from storing loans to shipping them out led for probably some incremental opportunity for private credit players. And on top of that, and I would say probably even more importantly, Mark Rowan and Apollo and others have called out that, banks have a bit of an asset liability mismatch in that if they are extending loans and storing them on their balance sheet, those loans are typically going to be funded by short-term deposits, held by people like you and me. And these deposits are, government backed with FDIC. So really it's the taxpayer that is the person on the hook if these loans go sour. But these dollars could be pulled out of the bank at any minute, like we saw in the regional bank crisis. So when you have that kind of dynamic on your liability side, short-term liabilities, and you're extending credit over 5, 7, 10 years, it could create some real problems when there's, for example, a run on the bank. the private credit, players came along and said, why don't we solve that by matching these assets, longer term loans with with longer term liabilities. It could be raising funds for private investors, or even increasingly so today, raising funds from the life insurance and wealth channel, where also generally there is a longer time horizon than a checking or savings account at a bank. So yeah, those are, I would say, the three big themes that brought private credit really to the forefront and allowed it to become more and more mainstream over time. As we'll get into, there's still a little bit of an asset liability mismatch even within the world of private credit, because while there are certain drawdown funds, and I would say this still represents the majority of the capital, where it's, investor capital locked down for 10 years and then extended out to loans that might also have, similar maturity lengths. There is a retail product, the BDC, that does try to offer investors partial liquidity or semi-liquidity, and I think this kind of brings us to the moment that we're in today. But I'll pause there, and maybe the one other wrinkle that we could talk about, if you think it is of interest, is just getting the vocabulary super crisp on what is private credit, because I think that too has been a bit misunderstood.
Chris, you're right. Yesterday, Taman and I were talking about this whole situation, and we were comparing it in many ways. What's happening with private credit now to like an equivalent of a run on the bank. And the asset liability mismatch, again, reminds us a lot about Silicon Valley Bank, which is one of the things that happened there. But I want to go back to what you mentioned about all roads lead to the 80s, when the great financial crisis was going on and you had all the subprime mortgage mess. I was thinking about the CDOs. And again, those were invented in the 80s. I know Michael Lewis was at Solomon Brothers, or I don't know if it was Solomon Brothers or Lehman Brothers is where CDOs were invented. But that is so striking that you say that all roads lead to the 80s in terms of some of these instruments, and they come to play out decades later. Before we get into some of Blue Owl and what's happening there, I want to ask a more mundane question as it relates to taxes and BDCs. And this is not the high tax law that you probably teach at NYU, but it's a more simple question that some investors might be curious about. So I love holding REITs in retirement accounts because REITs are required to pay 90% of their income as dividends, and they don't pay taxes at the corporate level. The dividends they do pay are non-qualified dividends, right? So they're not taxed at your 5, 10, 15, 20% rate. They're taxed at your ordinary income rate, so which can be quite high. And so holding them in a retirement account makes it really advantageous for me, because then I'm not paying those high dividend rates on those dividends. On the other hand, I also like oil and gas pipeline companies, but they are often structured as MLPs, master limited partnerships. And so even if you hold them in a retirement account, you're still going to receive a K1 that you have to go through the trouble of filing.
Mm-hmm.
So can you compare and contrast BDCs with REITs and MLPs? And are the dividends from BDCs non-qualified? And would holding them in a retirement account, would that make sense?
Yeah, absolutely, Asif. And actually, I should mention off the front end, none of this is tax advice, none of this is legal advice,
Yes.
and certainly not investment advice. And I do personally own all securities, and my fund owns securities in the companies mentioned in this podcast. So please, do your own work and know that my biases are out in the open as a long on firms like Blue Owl and Blackstone. With that legal disclaimer aside, to answer the simpler question, yeah, the BDC distribution, which in order to preserve the tax benefits they have to do, just like in the case of REITs, is a non-qualified dividend. And the reason for that is because these items of income were never taxed first at the corporate layer. Kind of the concept or the theory of why when you get an Apple dividend, you benefit from that lower rate is in part that income has already been taxed once at the corporate layer, but that's not the case in the REIT, that's not the case in the BDC. So for a taxable investor, you would be subject to your, potentially high income tax rates and not the preferential qualified capital gain rate that applies to qualified dividend. The MLP is not a great instrument or vehicle for tax-exempt investors, foreign investors, or people who just don't like receiving K1s, because those are ultimately, tax partnerships in a world in which capital markets have evolved towards tax exempts and foreigns being a larger part of the supply of capital. I would say in general, MLPs have gone a bit out of fashion. The interesting thing about oil and gas MLPs is they do benefit from, well, I don't want to get too much in the weeds, but they're not treated as publicly traded partnerships, which could have a bunch of other negative side effects. But in general, the MLP is not a great thing because you have to deal with filing, U.S. tax return if you're foreign and getting a K-1 and potentially other negative consequences. The BDC, on the other hand, just like a REIT, is a blocker. It's a C corporation at the end of the day, which means its shareholders are not receiving K-1s. It's as straightforward as owning Apple stock.
Got it. And you're right about MLPs. Kinder Morgan converted from an MLP structure into a corporate structure. So, a lot of that has been happening over time. And again, this is not investment advice, but there's some people who will hold the MLPs through an ETF structure. Like AMLP is one of those ETFs you can own and not get the K1s, but still pick up a decent yield, if not as high as holding them directly. So talking about yield a little bit more, I often see BDCs with very large dividend or distribution yields, sometimes approaching as much as, double digits, 15%. And they remind me a lot about mortgage REITs. So there's leverage embedded in the system with BDCs and with mortgage REITs. And that's in many ways one of the reasons I previously stayed away from BDCs. And I was looking forward to this podcast to learn from you about, some of the advantages of being in BDCs. But how does leverage work for these companies? And how are they able to pay such generous distributions or dividends?
Yeah, absolutely. So I think the best way to talk about it would be with an example. So let's take Blackstone's flagship publicly traded BDC. In their case, they have about $80 billion or so of assets under management, but only $50 billion is equity in the BDC, which is going to be applied to originate loans. But that equity is combined with about $30 billion of debt. And what's also kind of interesting, and it's now, at least as of today, coming to focus, is a lot of that internal BDC debt is still actually traditionally bank financed. So it's not that the banks have completely disappeared from the picture. So when you put the equity of the BDC, combine it with the debt, the kind of enterprise value for that Blackstone product is about $80 billion. And of course, it's that leverage that's embedded in the system that allows you to go from, owning loans that might be at SOFR plus, call it 400 or 500 basis points, so it could be like a 9 to 10% yielding instrument if all you had was the equity, but you combine it with the debt, which might be at a more attractive borrowing rate for the likes of a Blackstone, and you're able to kind of pencil out a return in the low teens for the ultimate owner or shareholder of the BDC. The thing to keep in mind here is the BDCs often don't trade at par or at the same as NAV, and the discount to NAV has been particularly acute in the last few months. I think the likes of like a Blue Owl or Blackstone or something at like 80% of NAV today, depending on the day. So even if the loans are performing, you might not be getting full credit for them if you ultimately want to sell your interest in the publicly traded BDC. The other dynamic that I think is worth calling out is the asset managers. And to be clear, I actually don't own the BDCs. I own the asset managers who are extracting management fees from the BDCs, but not for, in my opinion, because they've also done pretty good underwriting and have had strong performance up until this point. The asset managers are charging the management fee not just based on the equity, but on the enterprise value of the BDC. So there is that sensitivity, you can say, that if there is a swing in the equity of the BDC because these loans are potentially going to be marked down in an AI world, I can have my own views on that as well. Because they're levered vehicles, that could cause pretty big swings in the equity value. It could also cause a reduction in the total enterprise value, and in turn a reduction in the management fee that is collected by the manager.
Makes perfect sense. And it's interesting to hear that perspective as well. Maybe one last question from me before we start focusing on any one BDC in particular, and maybe it's a little bit more big picture as well. I was curious about two situations that developed late last year, the bankruptcies and credit problems that First Brands and Tricolor both faced. For viewers who might not be familiar with those names, could you dive into the story behind both these companies and why they might not be a signal for private credit systemic risk, as most investors had assumed? And feel free to take this opportunity as well to hammer out those definitions of private credit, as you mentioned. Might be a good
Oh,
situation.
yeah, perfect. No, it's a great question. Really, it's a good introduction to, I think, the biggest theme that I'm hoping to share, which is a disconnect between what you read about in the press and what's going on in the newswire and the reality on the ground. These two particular situations, First Brands and Tricolor or Tricolor, were bank originated loans. Loans I think that came out of the houses of Jefferies, JP Morgan, and others. And the reason those loans became problematic ultimately seems to be coming down to fraud on behalf of the borrowers. And the particular fraud that seems to be surfacing is the double pledging of the same collateral to different lenders. And the way they were able to get this far without being found out is, my understanding is, they've been tapping into different segments of the credit market, and not double dipping into the same segment. So, for example, they may try the high yield bond market and provide their information about their company to various high yield bond investors or banks, and tap that market, and then move on to the direct lending, perhaps private credit market, and provide the same set of docs, but not reveal that they've already pledged some collateral to the high yield bond market players. And they've moved kind of from channel to channel and tried to collect capital from people who may not be talking to other players in the space. Ultimately, the victims of this fraud were the bank originated, or the bankers who originated the loans and then syndicated them out to investors in broadly syndicated loans that come out of the banks. The kind of private credit players you may think of, like the Apollos, Blackstones, Blue Owls of the world, they did not have their hands on either of these situations or products. I'll have one caveat, which is for a short period of time, I understand that Apollo had purchased a piece of the bank syndicated loan from relating to either First Brands or Tricolor on the secondary market, realized that what they owned could potentially be a fraud, sold it immediately, and then shorted the credit by purchasing credit default swaps. So this, to me, illustrates the acumen of Apollo, and particularly the advantages that they have having platforms in different segments of the credit and bond markets. They actually do have a liquid credit desk. They have a institutional grade private credit desk. So they're really they have a great network within their firm to be able to figure out these things. So this was not a private credit story, but at least initially, name your reputable publication, FT, Wall Street Journal, New York Times, was calling it, a private credit mishap, and the canary in the coal mine, and the sign of perhaps worse troubles ahead. Now, what I would say is, even if now people are starting to realize this was not really a private credit issue, there's still the other argument out there, which is, we've been on a 16 or 17 year bull market in credit. So maybe this just tells us that we're in the beginning of a tsunami of like a lot of credits throughout the system going poorly because, lenders are overextended. Now that's a separate question. That's not unique to private credit. I personally don't have a strong view one way or the other. I think that A+ managers will probably be okay because they have the best talent, the best ability to suss out things in a frothy market. But that was the story of the summer, and that, I think, is what created a lot of the initial pressure on the players in private credit, and wrong ultimately. So then, to kind of get more into like the vocabulary and Mark Rowan at Apollo and others probably will explain this better than I can. But within the world of a Blue Owl or an Apollo, you have this thing that is broadly called private credit. But private credit is a huge, huge umbrella. A sliver of private credit is the direct loans to, sponsor-backed companies. For example, if like a Vista, Thoma Bravo, Clayton, Dublier Rice, Hellman Friedman, they take private a company, it's possible that a private credit player like a Blue Owl or an Apollo will step in and provide some of the financing. That gets a lot of the attention. That is, sort of what is the news du jour of, a lot of these 2020, 2021 sponsor-backed loans were in software, and now software has its challenges and it's in an AI world. But the reality is that world of sponsor-backed loans is just the tip of the iceberg of what private credit is. That is what I would call non-institutional grade private credit or direct lending. Beyond that, you also have private loans being extended to institutional grade borrowers to fund infrastructure projects and project finance, asset-backed finance, receivables financing. A lot of this is pretty boring business. Intel wants to create some new plant somewhere. They might go to an Apollo to get the financing for that. Or, on the more exciting side, if Meta wants to build a new data center, they might partner with the likes of a Blue Owl to finance that project. And the private loan, that private credit that was originated in the course of that project is institutional grade. In the case of the Meta JV for the Louisiana data center, it's rated A by S&P. So that is actually a much broader opportunity set, and I think is really the much greater opportunity that the likes of an Apollo, Blue Owl, or Blackstone are chasing to provide that kind of bespoke financing that high quality businesses might want as they go about, some major capital expenditure. And that just does not get very much coverage at all. The direct lending, the other side of the business, the thing that does get a lot of coverage, that opportunity set is really only as large as the private equity opportunity partners that they have. And, at least in the case of Blue Owl, they're writing loans in direct lending that are roughly 35% loan to value. So to use simple numbers, for every dollar of equity capital there is in private equity, maybe there's like up to $1 of like direct lending capital available to provide the debt. But Apollo and others have realized years ago that private equity is small potatoes. Like if they really want to double, triple, quadruple their market caps, they have to go after things much greater than private equity, whether that's infrastructure, real estate, or asset-backed finance. So that's kind of where the train is going. But right now, the focus seems to be on direct lending and leveraged loans.
Absolutely, Kris. And just to talk about the point you made about media focusing on some of these things, right? And they don't do, not always, there isn't in-depth coverage. But when First Brands happened and Tricolor happened, you also had Jamie Dimon come out and say, if there's one cockroach, there's likely to be more. And I guess the point you're making is that might be applicable to the broader credit markets that have had this tremendous bull run since the great financial crisis. And maybe there's more to happen on that front. But the structure of some of these BDCs and especially the asset managers behind them, they might have better protection despite the big drop they've seen in the stock price since the beginning of this year.
Yeah, exactly. And I don't have a view that's any broader than the A and A plus players. I can't speak to, I don't want to name names, but the names that I'm involved with, the Blue Owls, the Apollos, the Brookfields, the Blackstones, I consider them to be quality underwriters that have, top talent in the industry and continue to attract them and retain them, and are led by management teams who have been there, during the financial crisis and have been there during COVID and have experienced, at least in the words of Mark Lipschultz from Blue Owl, like there's kind of two sorts of situations. There's the real crisis when airlines are parked and it's a pandemic and cruises are not going anywhere, and you're long those companies, and you have to find a way out. So that's like a substantive crisis and is really difficult to deal with. And then there's what I think is happening today, which is a PR crisis, a crisis of confidence, and at least the on the ground fundamentals are pretty good up until this point. Now, I think what is really the question, at least at the top of my mind, is what is the reflexivity of negative perceptions on the growth of these businesses and their ability to keep their customers, their clients happy. Because it would be, I think, ignorant to say that the marginal, wealth investor or even institutional investor is going to just ignore the barrage of headlines when they're allocating their next dollar of capital.
Absolutely.
Right. This might actually be a good transition to switch over to the heart of our discussion today. We spent a lot of time discussing BDCs in a broader context thus far, but as you mentioned, looking at any list of the largest BDCs in the world, whether it be by assets or by market cap or enterprise value, names such as like Ares, Blackstone, and Blue Owl top the list. And Blue Owl in particular seems to have, or had at some point, a publicly traded BDC and then a non-traded BDC as well. Could you tell us a little bit about what's been developing at the company, a little bit about its history, and then the drastic merger decision between these two entities that the company made last year?
Yeah, absolutely. It's a great question, and there's a lot to unpack there. So, and this will probably reference some of the vocabulary mentioned earlier, but when Blue Owl really was starting out, they were launching what were considered closed-end drawdown funds that have a shelf period of, call it 10 years. And that was their private BDC, OBDC 22 or 11, but I'll just call it the private Blue Owl BDC. So that vehicle was launched in 2016. It had the mandate of lending to, doing direct lending to often sponsor-backed companies in a variety of industries, including software, but that's estimated to be something like 15% of the total portfolio. They have about 270 or 271 credits in total. And they attracted investors both from the institutional channel as well as, I understand, from the high net worth or ultra high net worth wealth channel. That private BDC scaled up to roughly $1.4 billion in AUM, when it launched. And to put that number into context, Blue Owl's total AUM today is about $307 billion. So we're talking about less than 1% of the AUM is in this, what is viewed as a problematic instrument, which I also disagree with, but it's actually a sliver of the Blue Owl complex. Anyways, that 2016 vehicle wrote very clearly in its legal docs that at the end of 10 years, we are going to provide, liquidity in one form or another to our investors. And basically there are three options. We can take this BDC public, and then you can get liquidity like in a normal IPO process. Second, we can merge this BDC with some acquirer, we don't know who, at X19 2016. Or we can wind down the BDC and begin the process of selling off the loans or holding the loans to maturity and just returning the capital back to the investors. So this is like a very kind of like, I would say, traditional private equity style closed-end drawdown fund structure, which a lot of the industry has kind of moved past since then, but this was kind of the vestige of that approach. So fast forward to today, it's 2026 and it's the end of, the life of the fund. What the management of Blue Owl had originally proposed to the owners of the private BDC, the investors, was, hey, we actually have this publicly traded BDC that has 97% overlap with the same credits, the same underlying portfolio companies, and so it would probably create some synergies and make sense to just merge the private BDC with the public BDC, because that accomplishes the goal of getting you, the investor, liquidity, and you can then make the decision on your own whether you want to continue with an interest in the publicly traded BDC or just sell it into the open market. And at the time that this project or this deal was announced, the private BDC was basically marked at par. There were no real defaults. I mean, they've been abnormally not abnormally low, but they've done a great job underwriting. So default rates have been low. Other kinds of indicators of shadow default, like PIK, payment in kind interest, has also been low. There's no real evidence yet of like amend and extend or waivers of missed payments, as far as I can tell, in the public domain. So the private BDC owners are owning this thing marked at par, and they have an opportunity for liquidity by merging with the public vehicle. Post announcement, all of this like barrage of negative headlines relating to First Brands, Tricolor, and other kind of hit pieces on the industry had come out, and the NAV, the discount to NAV, as we were talking about before, started to gap out in the publicly traded BDC. So from the perspective of the private BDC owner, they're currently holding paper at par, and they're being told they're going to merge into a publicly traded BDC at some point in the future that is trading at a discount to par because it's marked daily in the public markets. And so if that's the case, one is an enterprising arbitrage-minded private BDC owner might say, hey, rather than waiting for this deal to happen, why don't I just like redeem out of the fund and then maybe buy the publicly traded BDC interest on the open market? Perhaps I can capture some kind of excess value there. That's one kind of reaction to it. But another reaction, which makes sense to me, is like the market is not always right when it says something is trading at a discount to par. Like substantively, you're in the same kind of economic position you were before and after. But if you sell into the open market owning public BDC shares, you might not get 100 cents on the dollar because of that discount. So it may accelerate the desire to redeem early while the BDC contractually provides you a redemption at par subject to the 5% gates. So it was a lot of this kind of chaos that happened post-announcement that made that merger to the public BDC less attractive, even though I think management's intentions were sound and the synergies between the portfolios, make sense on paper. So they walked back that plan. They said, okay, let's pause the merger. This clearly was received poorly by the public, in part due to factors outside of our control. And instead, let's continue honoring redemptions, which they did. They didn't, skip a beat there. In some cases, I think they even lifted the gate beyond the 5%. But they also signaled that in parallel, we're going to work on some of the other paths to liquidity, whether that's the runoff of the loans or potentially an IPO, though that doesn't make sense because they know that it's going to trade at a discount. So that brought us to kind of the moment we were in, I think in around January or maybe early February, when they made significant progress on the runoff strategy. And they had announced hey, the way you guys are going to get liquidity, our 2016 investors, is we're going to just sell off this loan portfolio piece by piece. And the first transaction that was announced was a sale of 1/3 of the private BDC to 4 insurers. Four investors, 3 of which were CalPERS pension plan, OMERS pension plan, which is a Canadian pension plan, BCI, which is also a Canadian pension plan, and then Kavari, which is an insurance company. And these loans were sold at 99.7 cents on the dollar. Management has said there was no kicker or special incentive given out to the investors. They ran what seems to be a clean process. Now, there's, I guess, 2 kinds of pieces of hair on this transaction that I think is worth focusing on. One is that Kavari is an insurance company whose asset manager, Blue Owl, had purchased some while back. And what that basically means is that Blue Owl manages the float of this insurer. And this could be viewed as a conflict transaction because you're selling to the insurance company that you manage. Now, I would say the Blue Owl response to it, which I'm inclined to agree with, is the management agreement between Blue Owl and Kavari says that where there is such a conflict transaction, there needs to be a waiver, consent from the life insurer, and they're going to run a complete process given this potentially obvious conflict of interest. And the way that process went down was basically Kavari would not buy it unless other parties who have no relationship to Blue Owl are also willing to purchase the loans and so on and so forth. So yes, this was a sliver of the buyers, but you also have CalPERS and other very sophisticated pension plans in the mix doing their own underwriting. So that's one piece of hair. And then the second piece of hair is, and this kind of goes back to something I came across in legal practice, which is if you ever find yourself in litigation, you can get the same set of facts and view them completely different ways, and that's what a good litigator does, is they spin facts upside down and tell a completely different story. So the story I believed in was, look, they're being productive in liquidating, and they're getting marks that are consistent with their internal marks. But the counter that's out there is clearly they must have cherry picked, the best assets to instill like investor confidence. And now there's all the more reason to redeem if you're like a private credit investor, or to somehow exit out or sell your shares to Saba Capital or some other, opportunistic tender offerer, because what's left behind is even worse than what was there before. Now it's hard. Yeah, it's hard to prove that. You could look at the BDC portfolio, 270 plus credits, and go one by one and try to triangulate what was sold, what was left behind. Or you can, in my opinion, take a more legalistic approach, which is on recognizing that Blue Owl has a fiduciary duty to its shareholders, in their private BDC, and to do such a transaction that disadvantages those who are going forward and advantages those who've redeemed early would be a big, misstep, an obvious misstep to any well-advised asset manager, particularly one that has ambitions to scale its AUM, much more from here. That would be a catastrophic error. So I find it hard to believe, though it is appealing, to go down that path.
Yeah, so Kris, you've touched upon a couple of criticisms that I have of BDCs, and one of the reasons I avoid them, one is they are like a black box, right? So you don't really necessarily know what they have in there. I mean, when you're investing in a REIT, for the most part, especially if it's like a hotel REIT or an office REIT, God forbid you actually invested in an office REIT, but at least you get to see the kind of properties that they have. You can go often to their website, or you can look at the 10K or 10Q, and they list out the properties they have. So one concern I have is, the black box nature of both private equity as well as BDCs. But the bigger thing that I took away from your response there was, people often say that, at least with publicly listed BDCs or publicly traded companies, you have mark-to-market accounting. While on the private side, some people say it is mark-to-fantasy. You can really mark it to whatever you want at the end of the day. I know that could be litigation that would uncover that. But we see this on the equity side as well, right? So WeWork was using community adjusted EBITDA as it was planning to go public, and that's what it put in its S1 filing. You can see Figma go down 75-80% after it went public. I see it as private market valuations reaching the shore of public markets, right? So there is this harsh reality. They're now under the sunlight. People can see what's going on. So I wonder if that's also a concern that people have, that it's really marked to fantasy rather than mark to market. And how do you address that? Or how do you get around that risk, if you will, where you don't have deep insight into what's going on in these BDCs or private equity companies?
Yeah, no, absolutely. It's a great question. I would say there's 2 points I would want to tease out there. One is, at least in the narrow situation involving the private BDC that Blue Owl had from 2016, where we were told there's 97% credit overlap with their publicly traded BDC, that provides a great opportunity for, investors to go underneath the surface, because just like with a publicly traded REIT, the publicly traded BDC has quarterly earning calls. Craig Packer, who's one of the executives at Blue Owl, is leading these calls. You can see their quarterly filings. You can see how many credits are on the watch list. You can see how many are on PIK year over year, which tends to be an indicator of shadow default. And you can see that that's also trending downwards year over year. You can see what are the top 10 largest credits in the portfolio. You can see what percentage by industry. The level of disclosure, I think, is actually much better than people give Owl and others credit for, given that they have publicly traded BDCs. Now, the point would still stand, though, in perhaps other situations where all you have is a private BDC, but their, disclosure is kind of at the, you could say at the will or the generosity of the issuer. And at least for the top tier managers, they too, in my opinion, do a pretty decent job of educating their investor base on exactly what it is that they own. So maybe taking a step back from Owl, what I would kind of draw as a great analogy, and this goes back to your second question about how the public markets are ultimately the acid test of value. We should take a look at the 2022 situation at BREIT, which was Blackstone's private REIT product. So Blackstone, I would say, has been the pioneer in private wealth, or accessing that channel, whether it's on the tax exempt side of 401k or on the after tax side or on the life insurance side. With BREIT, that was their flagship vehicle to allow mostly high net worth and ultra high net worth investors to access Blackstone's premier real estate private equity franchise. And in 2022, as interest rates started going up, there was a huge drawdown in the publicly traded REIT market because, in a highly interest rate sensitive asset class like real estate, you can imagine how that would affect property values, whether it's an office building, which would probably be particularly stressed given the Zoom workplace environment we were living in still then. But also other asset classes, hotels, hospitality, retail, etc. So the publicly traded REIT index was getting killed in 2022. Blackstone's perspective was, we own real estate in the right neighborhoods. We're not a representative, REIT product. We've been very selective in what's inside of BREIT, and you can see in our, voluntary disclosure to you, our private investor, is what we own is mostly warehouse and logistics, increasingly post 2022 data centers, which is of course, been on a tear, very little office space, a good amount of multifamily, which is overall pretty good, though now is facing some regulatory pushback, which is a separate point. But overall, they were in the right neighborhoods, in the right places, and so they were unwilling to mark down their portfolio in BREIT, given their confidence in their portfolio. But critics would say, clearly, the fox is in charge of the hen house, because how can you say that with a straight face when public REITs are down so much? That began a onslaught of redemption requests by BREIT investors who basically had the strategy in their mind of, let's get out of private BREIT and just reinvest that capital in the public REIT index, and we should get better returns because now we got redeemed at par and we're investing at 60% discounts to NAV or something along those lines. But 4 or 5 years later, what we're seeing is BREIT has continued to perform. They haven't really had a major down year. I think I haven't looked at it in a while, but I think maybe their biggest year-to-year drawdown, so to speak, could be just a marginal return of 0.5% and 50 basis points, something like that. But they had not, they refused to take, a real hit on their marks. And fast forward to today, they've met all their redemption requests. I believe they now have net inflows, and their product has outperformed the publicly traded REIT index by 2 times, right? And so they've survived. They've survived the chaos around real estate in a high rate environment. And in my opinion, the increase in interest rates is real and substantive, and they still got through that. Whereas the panic around, BDCs with 15% software portfolios is still largely speculative, because it comes down to whether you think software can innovate in an AI world, which we know there's very smart people on both sides of this debate. You have the Citrini research report on one side, you have Citadel Securities on the other side, and you don't have to really take a strong position on it, but if you're kind of somewhere in the fairway, you can get comfortable, I think, in a way that would have been harder to get comfortable with in 2022, when interest rates, an objective factor that impacts real estate values, had gone on so much. And even still, Blackstone, which was a high quality player, in my opinion, the highest quality player in real estate, had gone through this. So yeah, I think where I ultimately come down is you do have to have some level of trust with a manager, but you don't. These managers have gotten to the point they are today because they've earned it through track records through cycles, whether it be in credit or real estate. And I would say another reason I'm particularly bullish on the likes of an Apollo or a Blackstone or a Blue Owl is because the management teams here have seen just way worse storms, and these firms tend to do their best work when there are major dislocations. And what I think is a very positive indicator is that Blue Owl, even after all of this negative press around the software exposure they have, recently, I think as of last week or maybe 2 weeks ago, extended a new money loan to Vista in the context of a software LBO, right? So they're still playing the game, knowing that it's not being received well by the market, and they continue to put out new good money into this channel. And if they're right, and software survives, or at least the senior security position that they're taking survives, which is kind of the best place to be in the capital stack, to the extent you have all of your subsidiaries within the credit group. If they're right, then they're going to be looked at as like the lender you want to go to when you do your next technology LBO, because they were there, extended capital when most people pulled out because of the negative perceptions. So that's like another thing I would counsel. Like, yes, it's important to pay attention to the insider transactions and how management at Blackstone, for example, stepped in to satisfy the redemptions that we're seeing in BCred, and how Blue Owl employees and management have also, played somewhat of a role in buying stock of the publicly traded BDC, and the company has also issued their largest authorized buyback program in its history. But I would say the most important thing is that they continue to do the business that is supposedly challenged, because I don't think they have to do that if they feel that this is, a money losing enterprise. But they believe in what they're doing. In the words of Mark Lipschultz, is there's no red flags, there's not even any yellow flags. So we're not going to stop, lending to, top quality players in top quality businesses, even if they're in technology sector. Sure, that there's going to be disruption, but there's a price for that. And that's why it comes back to Michael Milken, which is, okay, if we were going to get SOFR plus 300 basis points, 3 months ago or 4 months ago, maybe we can get SOFR plus 600 and also still be viewed as a well-regarded partner to the top players in the space, and also be a bit more selective on the credits we participate in as the supply of other players, sort of ekes out of the market.
Absolutely. And I think there's so many threads to pull at with that response. Absolutely fascinating from start to finish. I think maybe one thing we could touch on is Blue Owl's connection to software. So you mentioned the software LBO loans to Vista, but then maybe even talking about the data centers you mentioned with BREIT. I think one of the big deals Blue Owl found itself in last year was the new joint venture with Meta, where they closed, I think it was $27.3 billion to develop the Hyperion data center campus in Louisiana. And it seems like Meta managed to keep this $27 billion in debt off the balance sheet entirely, which seems to be a growing trend in the tech industry. I remember reading a few months ago about how companies like Oracle, XAI, CoreWeave, and then Meta as well, and more, they're putting over $120 billion of AI data center spending off of their balance sheets. So it seems like EY has flagged this Meta deal as a critical audit matter, but has let it pass. And certain investors have drawn parallels to Enron's use of SPVs in the early 2000s. I'd love to hear a little bit more about what your thoughts are on this entire situation and how you're viewing the rise of these new off-balance sheet deals and how it might tie to Blue Owl as well.
Yeah, no, absolutely. So these off-balance sheet deals are what I would put in the category of private credit, and particularly their project financing or asset-backed financing to institutional grade borrowers. And so this is where I think the train is going. I think it's generally a positive thing for the industry, and it's a much greater opportunity set for the likes of an Apollo or a Blue Owl or a Blackstone to provide money to institutional grade borrowers like Meta and still get excess return relative to owning institutional grade bonds. I mean, that the alpha there is the fact that a Blue Owl or an Apollo can get 200 or 300 more basis points than they would if they just bought Meta bonds. The critique, though, is also very valid, which is as these liabilities of Meta move off balance sheet, it might obscure the picture for public market investors who are trying to understand, the debt picture at the likes of a Meta. I think that is really a question for Meta shareholders and Meta management or other companies who are participating in these transactions to grapple with. But from the lender's perspective, from the Blue Owls of the world's perspective, these are pretty solid deals. I think the way I think about it is at least 6-7 years ago, no one thought that you could extend private credit to anyone but a, leveraged LBO, 3 times debt to equity kind of situation. And now all of a sudden, the consumer of private credit are some of the best companies in the world with the largest market caps with institutional grade ratings, and you're still able to get pretty attractive returns, at least for now, if you're Blue Owl. So I think that's interesting. I think it's a great opportunity, and I think the devil is very much in the details of what happens if these projects go sour. Who ultimately suffers from such a situation? So in my study of the Hyperion data center deal with Meta, basically the terms of the deal are Meta is paying lease payments to this joint venture that they own 20% of. And because they only own 20%, that's why it's off balance sheet in the accounting standards. But they're making operating lease payments to the JV. So that is potentially beneficial from Meta's perspective because it doesn't look like a capital expenditure. It looks like an expense. I'm not exactly sure why they prefer those optics, but substantively, they've financed the construction of a data center. They've put up, the vast majority of the capital, but they're reporting it as a lease payment. Blue Owl is will make money on this deal on them putting together this financing package. But Meta has the option to renew or back out of the lease like every 4 years or something like that. But if they decide that, hey, we don't want to deal with this data center, like this was a terrible idea, then they have to pay the JV basically the residual value of the project. And so there's a lot of downside protection for the likes of Blue Owl and the other investors that are in the consortium, like a PIMCO, where basically it's a bit complicated, but basically any debt that was used to finance the JV has 100%, 100 cents in the dollar protection from Meta because the residual value is going to be equal to those debt payments that go out to the debt investors. So it's a pretty good risk reward structure from Blue Owl's perspective and from the debt investors' perspective. And I think that's why it was also it's a fairly competitive project. I think Apollo was interested as well in being the partner here, but Blue Owl does have a lot of data center expertise through their acquisition of IPI, which was also a very hot asset. And you really want to partner with someone who knows what they're doing when it comes to building this mission critical asset like a data center in today's world. So they won the deal. So yeah, it's an interesting situation. I think it's actually a better risk reward than what has been the legacy business of any of these private credit players.
So we started our conversation off today about insider purchases, and I think I want to come to that before we wrap up as well. We've seen Blue Owl's co-CEOs both step in to purchase shares of the business, and it doesn't seem like they're alone in their purchases either. We've seen insider buying at similar firms such as KKR and Blackstone over the last few months and weeks. The purchases by director Ruth Porat, who happens to be the chief investment officer at Google and Alphabet and was formerly the company's CFO, those seem to be part of an automatic dividend reinvestment plan, so they aren't much of a true signal. However, at KKR, we've seen 5 different insiders pick up shares on the open market since the start of this year, including both co-CEOs, who bought nearly $13 million worth of shares each. A big part of what we do at Insider Arbitrage is take a look at these insider transactions, and we were wondering if you had any extra insights to share about the purchases across various firms.
Yeah, I think there's there's a lot of ways to consider what constitutes insider activity here. So there's that, buying shares of the pubco of a KKR, which I think is the immediate signal that comes to mind. But I don't yet. I haven't seen like super exciting activity in that space because as you mentioned, Ruth Perret, she always is kind of buying shares of Blackstone from time to time. It doesn't seem like it's far from it's nothing unusual. And for the co-CEOs of KKR, Joe Bay, Scott Nuttall, I mean, these are billionaires. $13 million for each of them. It doesn't, I don't think, really moves the needle. I think it's a nice signal on the margin. But I try to view it in the context of their broader portfolio. What I think is more interesting and is a true signal is what we saw at BCred recently at Blackstone Credit, where basically investors wanted to be redeemed. The gate said 5% is the limit. Blackstone said, okay, we're willing to actually redeem you up to 7%. So we're voluntarily getting more people out if they want out, and probably that is meant to build more goodwill with the private wealth channel. And play the long game here because not everyone will be able to do that. When the tide goes out, some people will not be able to lift their gates. So they got up to 7% organically through the fund itself, redeeming their investors. But then I think roughly 25 or so executives put up, I'm blanking on the number, but I think it was $125 million, maybe more, to provide secondary liquidity to also allow those investors in the BDC, in the private BDC, to get out. So that is a very kind of bespoke version of a buyback because it's getting right to the source of the problem, right, or the perceived problem of the BDC. So whereas if they just bought insider shares in the pubco, their interest is like, or their view is in a way diluted by the fact that Blackstone has all these other great franchises, whether it be in infrastructure or real estate or hedge fund solutions that have nothing to do with the source of the problem. But the fact that here they stepped in right into the BDC, right in the heart of the storm, to me signals confidence. Now, of course, these executives are also billionaires. We're talking about Steve Schwartzman and John Gray and people like that. But that I like to see quite a bit. And at Blue Owl, similarly, not just senior executives, but even lower ranking management were stepping in at their publicly traded BDC, a couple of months back. I think we're still in the early innings of this. I would like to see more, frankly. And one thing that does give me some pause is it's reported that, or even it's provided in the disclosure that a couple of the executives at Blue Owl have pledged their interests in Blue Owl stock as the collateral for some financing. They went on to buy a hockey team, maybe some other assets. And so with the stock cratering as much as it has, there's, in my opinion, somewhat valid concerns of some sort of margin call on their pledged shares. I think they're going to find a solution to this because, even before Blue Owl, these were very successful people that, one was first 20 employees at KKR. The other was the head of leveraged finance at Goldman Sachs. The other founded GSO, which was the credit business that became Blackstone Credit. So they have plenty of assets, I believe, even outside of their Blue Owl interest. But in addition to that, if they really are going to be forced sellers because of some margin call on their Blue Owl shares, I do believe someone else will step to the plate to buy those shares in the secondary market rather than, them dumping their shares into the public market, particularly right now. So it's a very interesting, fast-moving, dynamic situation. There might even be consolidation or M&A if things get really bad, or more activist-related activity.
So just going to your point about somebody else stepping in, we wanted to talk a little bit about Boaz Weinstein and Saba Capital. And as we've seen, they've stepped in to launch a tender offer to acquire shares in the non-traded Blue Owl BDCs. I would love to hear a little bit about what makes, Boaz Weinstein so special as an investor for people who are not that familiar with him or Saba Capital, and why this decision is fascinating and what it might signal.
Yeah, absolutely. So I think Boaz has really made a name for himself recently, targeting closed-end or open-ended funds with sponsors like BlackRock and others, and sort of finding interesting arbitrage situations, taking advantage of fear and providing liquidity and trying to close discounts to NAV. I think generally speaking, that has been his playbook, or at least his most public strategy in the last few years. And there's no shortage of opportunities if that's your style. What he's doing, which I've been more focused on, is specifically with regards to Blue Owl, is saying, hey, clearly there's a lot of panic. We see that private investors in the private BDC want out because they're hitting the gates of 5%. And maybe that is going to be, maybe that's going to increase over time as these negative headlines come out. So why don't we just make a tender offer to whoever wants out at, let's call it a 30% discount to NAV. It's a low ball offer. And I'm not sure I think he himself has admitted, like, I haven't really done the work on this loan portfolio, but if the offer is low enough, like, I should be okay. I think that's reading in between the lines of his tweets and other things like that. That's the sense that I get, that he feels that he can set a floor for price and still have protection. And, he's not wrong. I mean, I think if you have that capital and people are willing to transact, it could be a productive trade. And I've heard others float similar ideas. I would signal your audience to look at the tweets of Kent Collier, who's the founder of Octus, which is a distressed debt, or I think it's broader than that now, but it's like a debt intelligence platform. And he's also has a lot of experience as a credit investor, talking about similar sorts of opportunities if the market is willing to transact. So yeah, I think he's opportunistic. I think he seems to not have a particularly bearish view on the loan portfolio. Otherwise, he would be asking for probably a much wider discount than what he's asking for. But I think he also sees that private investors seem to want out, and who better to buy from than a forced seller or a panicked seller. So that's the state of play. Personally, what I think is more likely to happen is Blue Owl, Blackstone, name your kind of sophisticated publicly traded alternative asset manager. They have a pretty deep toolkit of how to solve for liquidity situations like this in times of crisis. Particularly the continuation fund comes to mind, where basically they say, like, okay, people want liquidity. We've gotten to the end of the 10 years, but now it's just not a good time to sell these loans. Or, I mean, they're trying the strategy of selling loans, and so far they've gotten the marks they wanted, but who knows, maybe the next insurer or pension plan gets skittish. In that case, they still have other tools in their toolkit, which could be raising a new special purpose vehicle, a new continuation fund, buying loans, providing liquidity to those who want out, rolling over for those who are still confident in the project. The reason I think they have a good chance of executing on this is because of something that Mark Rowan has said repeatedly, way before any of these crises have came out, which is there's a shortage of good credits, particularly in the levered loan market. And there's a huge supply of capital chasing, a finite set of opportunities. So I don't think, Blackstone or Apollo or Blue Owl is going to struggle to raise a $1.4 billion SPV if that's what they need to do in order to provide liquidity to the remaining private credit investors who want out right now. They have that tool in their toolkit. I mean, the rules are kind of being written as we speak. When BCred had this problem, when BREIT had this problem with Blackstone's private REIT franchise, their approach was they brought in CalPERS on some preferred terms, and that provided some additional liquidity to the investors who wanted out. And that I would consider to be a more aggressive step, because now you've provided preferential terms to someone to step into the loan portfolio. But we're not there yet on the private credit side, and I don't think we're going to get there because these credits are relatively special, in my opinion, relative to how much capital is trying to chase the opportunity of getting excess return above the high yield bond market. Yeah.
Absolutely. Speaking about options investors have in their toolkit, specifically these companies having these toolkits, as well as investors wanting out of firms like Blue Owl, once that wave passes, maybe big picture, what is the catalyst or some key metrics that investors should be looking out for a sign that tides are changing at Blue Owl? Especially since you mentioned there's a lot of matters about perception and how it's being portrayed in the media. How might we start to see a switch there as well?
Yeah, no, that's a really important question. How do you quantitatively track what's going on? I would say a few things. One, the North Star in my book is credit quality and tracking whether there's defaults, whether actual or shadow defaults. And the best we have to figure that out is looking at whatever press releases management puts out, whatever's in the publicly traded BDCs, being laser focused on the high profile situations. And, there's a lot of read-throughs. Blue Owl might not own the credit all themselves. There might be another asset manager in the mix somewhere in the capital stack marking down the loan. Somewhere, somehow, you'll find out about what's going on with the larger, problem childs, if there are any. And I think a investor here needs to not skip a beat and pay very close attention to all of those loans. The second thing that matters is, okay, let's assume the credits perform as I hope they do. Then the next question is inflows versus outflows, right? Because in the case of a Blue Owl, what the public gets, the public shareholder, is just the management fee on on their whole slew of products, and so it's an relatively easy thing to value, and right, there was a time where these fee-related earnings were getting really high multiples, 20, 25 times, because they were viewed as a royalty in perpetuity. But at today's prices, this is changing minute to minute. It could be as cheap as 8, 9, 10 times fee-related earnings. At that multiple, you don't need to pencil out that much AUM growth to get an attractive equity return. But you probably still want some, right? Because if you have an implied return of maybe 10% at 10 times fee-related earnings, most people would want to at least be in the mid-teens, and in a situation like this, probably be a lot higher given how much hair there is in the situation. So I would be laser focused on paying attention to net inflows or outflows across their portfolio, and that's a metric that comes out every quarter, basically. The sense that I get is right now, even though private wealth, the ultra high net worth, the high net worth individual is skittish, and I don't blame them given how much negative press coverage there is. Institutional investors are still pretty firm, but that can change quickly. I think ultimately institutions are people, run by people, investing for people. There's the end user of all this stuff is the individual or the end consumer. So I'm paying close attention to that as well. It could be a rough road for the next 12 to 18 months. It took Blackstone 3-4 years to recover from the perceived crisis at BREIT, and they have probably the strongest brand in alternatives. So I would say this opportunity is not really for the faint of heart. It's someone who's taking a long-term position on these companies. And I think the big picture question is just, do you think Blackstone is, or Apollo or Blue Owl or Brookfield, name your firm, is going to be a larger business in 5 years from now than it is today?
Because you said something that is very relevant thing, where industries that are in crisis often see bankruptcies and then M&A activity, right? But in this case, the net inflows could be an early signal. You don't have to wait until the industry hits bottom through bankruptcies and M&A. So that is very useful. I had something similar that somebody shared with me during the great financial crisis when I was asking an ex-vice chairman of Wells Fargo who was running his own mortgage firm, what kind of signs should I look for as to when this real estate bubble is going to burst in 2006, 2007? And he said, watch for a real estate inventory to hit 9 months. And that's when the stuff is going to hit the fan. And so in this case, it looks like the net inflows is what we should be focusing on. So that's very helpful.
Yeah, absolutely. And I think the thing to remember is these are not banks where there can be an overnight run, right? That was the whole point of why this exists, to have some closer asset liability mismatch. So on one side of the Blue Owl book, you do have these BDCs that offer up to 5%, redemption. But that too could be a managed process over the course of months or years. And then also they have so much capital in the traditional drawdown closed-end funds that have 10-year shelf lives. So my sense is there's actually quite some runway from where we are today to where we actually start to see real deterioration in fee-paying AUM. And I think that runway is critical. It's something that banks wouldn't have in this situation. And it really buys everyone time to see how the AI story plays out, to see how management does communicating their side of the story, which right now it's been a pretty one-sided debate on what's going on at these firms. But yeah, absolutely agree that we have to pay close attention.
Absolutely. And it'll be fascinating to see how that runway develops over time. And with that, Kris, thank you so much for coming on. We really appreciate it. I personally got to learn so much about private credit and BDCs, a space that I wasn't familiar with previously. Before we wrap up our conversation today, I wanted to ask if there's anything you'd like to speak about that we haven't yet covered, and then perhaps also where could our viewers or listeners find you?
Yeah, yeah, absolutely. I mean, there's so much in this story. I would say I'd point your readers to, frankly, who I consider to be better experts at this than myself. So, I mentioned Kent Collier before from Reorg. I would, recommend that readers also listen to management. Of course, they're speaking their own book, just like I am. But I do think there's compelling arguments being made by the likes of a Mark Rowan or Mark Lipschultz or John Gray. They're out there on CNBC and Bloomberg. Just, listen to what they're saying with an open mind would be my advice. And then the other thing I would just say, which is also a bit, big picture, perhaps even a bit metaphysical, is what do crises really look like versus what don't they look like? I'm thinking about the regional bank crisis, where basically over the course of a weekend, we saw Silicon Valley Bank is going under, and things happened quickly, and the Fed stepped in immediately, and things changed overnight. This situation has been one where it used to be every month, and now it's every day. There's a negative headline about the industry, and there's a lot of eyeballs paying very close attention to what's going on. There's a lot of research. There's a lot of short interest, and there's plenty of people who've been critical of this industry for the last 3+ years. I think that is generally not the recipe or the cocktail for a run on the bank situation or a go to zero situation. It's almost because there's been so much awareness and criticism and pretty healthy regulatory debate on this asset class that makes me feel more comfortable. Of course, we have to be grounded in real fundamentals to invest and put client capital at stake. But it just doesn't, to me, have the smell of something like an overnight crisis that creates problems. Now, I was not that, I wasn't that attuned to what was happening leading up to the financial crisis, and whether we were seeing headlines like we are now in 05, 06, 07 about mortgage-backed securities and CDOs. But my sense is that it wasn't really in the crosshairs until it was too late. Whereas this has actually been in the crosshairs for quite some time, and the managers have also been through the rodeo before. In terms of reaching me, I'm now experimenting on Twitter or X, so you can please follow me, like, subscribe. I'm probably getting terminology wrong. At Legal Fin Guy, LegalFinguy. You can also connect with me on LinkedIn. My DMs are open if you want to talk ideas. And yeah, would love to connect. And I'm really grateful to both of you for having me on, and your audience for listening to my spiel.
Thank you so much, Kris. Just as Samana mentioned, I learned a lot. It was amazing to have you on, and we could probably do a whole additional episode just talking about the impact of software and what's happening with AI and how that's disrupting the private equity firms and private credit as well. Really appreciate you coming on and spending time with us today, especially considering the new addition to the family.
Of course. No, thank you.
Thank you so much. Really appreciate it. And that wraps up episode 58 of the Special Situations Report. It was absolutely wonderful having on Kris Kania as our guest for this week. If you'd like to access a more comprehensive weekly overview of all special situations activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the event-driven world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you might be listening on.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. We or our clients may hold a position in any of the companies discussed today. Nothing discussed on this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.